Welcome to Good to Know. The stock market can be an intimidating place for beginners, with its complex terminologies, fluctuating numbers, and seemingly endless graphs. However, with a little guidance and patience, anyone can grasp the fundamentals of interpreting stock market charts. In this article, we will break down the key components of stock market charts and provide valuable insights for beginners to make informed investment decisions. So, let's dive in. Introduction to stock market charts. Stock market charts are visual representations of the historical price movements of individual stocks, indices, or any other financial asset traded in the market. They serve as a crucial tool for investors and traders to analyze past performance, identify trends, and predict potential future movements. There are several types of stock market charts, but the most common ones are line charts, bar charts, and candlestick charts. Each of these chart types conveys different levels of information, and it's essential to understand how to read them. 1. Line charts. Line charts are the simplest and most straightforward form of stock market charts. They depict the closing prices of a stock or an index over a specified period, usually displayed on the vertical y-axis, with time intervals on the horizontal x-axis. Reading line charts. Understanding trends. By connecting the closing prices over time, line charts show the general trend of the stock. An upward sloping line indicates a bullish trend, rising prices, while a downward sloping line represents a bearish trend, falling prices. Identifying support and resistance. Support levels are price points where a stock's decline is expected to halt due to increased buying, while resistance levels are price points where a stock's rise is expected to stop due to increased selling. 2. Bar charts. Bar charts provide more comprehensive information than line charts by illustrating the open, high, low, and close prices of a stock for a given time frame. Each bar represents a specific time period, day, week, month, etc., and the height of the bar represents the price range during that period. Reading bar charts. Price range. The top of the vertical bar represents the highest price reached during the period, while the bottom of the bar indicates the lowest price. The horizontal lines extending on the left and right sides of the bar show the opening and closing prices, respectively. Candlestick interpretation. Candlestick charts are a variant of bar charts that offer the same information but are more visually appealing. Each bar, or candle, is colored differently to indicate whether the stock closed higher, bullish, or lower, bearish, than its opening price. 3. Candlestick charts. Candlestick charts originated in Japan and have become one of the most popular chart types worldwide due to their ability to convey price information effectively. Reading candlestick charts. Candlestick anatomy. Each candlestick consists of a body and two shadows, upper and lower. The body represents the price range between the opening and closing prices. If the closing price is higher than the opening price, the body is typically colored green or white, bullish. If the closing price is lower, the body is colored red or black, bearish. Shadows. The shadows extend from the top and bottom of the body and represent the highest and lowest prices reached during the period. Patterns. Candlestick charts have various patterns, such as doji, hammer, engulfing, etc., which can provide valuable insights into potential trend reversals or continuations. 4. Time frames. Stock market charts can be displayed in various time frames, ranging from minutes to decades. Common time frames include intraday, 1 minute, 5 minute, 15 minute, daily, weekly, monthly, and yearly charts. Different time frames offer different perspectives on stock price movements. Choosing the right time frame. Long-term investors. For long-term investors, weekly or monthly charts can be more insightful as they smooth out short-term fluctuations and provide a clearer picture of the stock's overall trend. Short-term traders. Traders looking to capitalize on short-term price movements may prefer intraday or daily charts for more precise entry and exit points. 5. Technical indicators. To enhance chart analysis, traders often use technical indicators. These are mathematical calculations based on historical price and volume data that can help identify trends, momentum, volatility, and potential reversal points. Common technical indicators. Moving averages. Moving averages smooth out price data and help identify trends by showing the average price over a specific period. Relative Strength Index, RSI. The RSI measures the speed and change of price movements, indicating overbought or oversold conditions. Moving Average Convergence Divergence, MACD. The MACD displays the relationship between two moving averages, signaling potential changes in trend direction. 6. Fundamental analysis versus technical analysis. It's essential to understand the distinction between fundamental and technical analysis. Fundamental analysis focuses on a company's financial health, earnings, growth prospects, and industry trends. On the other hand, technical analysis solely relies on historical price data and patterns to predict future price movements. Both approaches have their merits, and many investors use a combination of both to make well-informed decisions. Conclusion. Understanding stock market charts is a critical skill for any aspiring investor or trader. By comprehending the various types of charts, timeframes, and technical indicators, beginners can gain valuable insights into a stock's performance and potential future movements. Remember that interpreting stock market charts is not an exact science, and practice, patience, and continuous learning are key to improving your chart analysis skills. Combine chart analysis with fundamental research to make well-rounded investment decisions and, most importantly, always manage risk appropriately. Please subscribe to our channel.